Okay, welcome back. Just having some problems with the camera there for a bit. So we were about to move on to calculating light, heat and fuel, depreciation, repairs and interest. And we were going to have a look down here at the extra information, see if it said anything about any of these expenses. So first of all, the one to notice is part 4. It says other expenses. So the other ones, apart from the ones you've already tackled in the cattle and milk and sheep accounts, the other expenses are to be apportioned 80% to farm and 20% to household. So that is because most farmers live on their farm in the farmhouse. So there's probably one electricity bill, for instance, coming in, and that is the electricity bill which is for electricity that was used in the cattle sheds, but also for electricity that was used when the farmer is watching television at night time, So what we say is some of these bills should be paid by the farm. In fact, 80% of those bills should be paid by the farm, but 20% of those bills should be paid by the farmer themselves because they're private bills. And we know what we call that. We call that drawings, isn't it? When the farm ultimately will pay the entire bill, but 20% of it will be for what the farmer used. So we call that drawings. And remember, what we want to put into this profit and loss account is just what the farm ought to be paying, not what it actually did pay, or not including drawings. Okay, so for each of these 1, 2, 3, 4 bills here, we are going to reduce them by 20% or calculate 80% of the total cost of the bill. Right, that's one thing. Next thing, depreciation to be provided on machinery at a rate of 10% of cost per annum. So that will come into play when we're calculating depreciation. Right, in that case, let us get going straight away, I guess, and we'll start with the light, heat and fuel here. Now, there's a bit of work in this. So light, heat and fuel I'm going to put down here. Okay, so here's how we go with this. We look at, first of all, the actual amount of money paid out during the year for light, heat and fuel. And it says this, according to our check payments, we paid out $3,400 during the year for light, heat and fuel. Now, remember, all we're interested in is what you should have been paying out for that period, though, not necessarily what you did pay out. So in order to find out what you should have been paying out for the year, we look at the start of the year and then we look down here at the end of the year also. So if we go up here, we'll notice at the start of the year there was this electricity bill due of €400. That means at the start of the year you owed, or the farm owed, €400 in electricity, a bill from last year, presumably electricity that was used up the previous year but still hadn't been paid and was still owing at the start of this year. So we assume then when you paid out all of this money for light, heat and fuel, including electricity, during the year, that you actually did pay off that bill. But that bill was for last year, so we don't want to include it in this year's accounts. So the first thing we're going to do is reduce that amount that you paid by the 400 from last year's bill. Okay? Next, up here at the top as well, there's stock of fuel 800 here, and that stock of fuel is fuel that you bought and paid for, we assume, last year, but you had it left over. You had it at the start of the year left over from when you bought it last year. You didn't use it last year, so it's for this year. You paid for it last year, so it's not included in this $3,400 that you paid out during this year, but it should be included in this year's accounts because it's fuel that you're going to use this year if you had it left over at the start of the year. So we're going to add on that 800 here. Okay. Similarly, at the end of the year, if there were any electricity due at the end of the year, that would mean that there was a bill that arrived during the middle of the year or near the end of the year that you still haven't paid for yet, and that means that wouldn't have been included in the payments that you made, but would need to be added on to the electricity that you used during the year, assuming that that bill arrived for electricity that you used during the year. So there's not in this case, but often there could be electricity due at the end of the year, so you would add that on. So subtracting electricity due at the start of the year, adding on electricity due at the end of the year. Okay? Lastly, there is a stock of fuel left over at the end of the year. So this stock of fuel, you assume you used up that stock during the year that you had at the start. And this stock of 900 was fuel that you bought during the year, okay, but you haven't used yet. So what you're going to do with that is, assuming that you bought it out of this money that you paid for light, heat and fuel, but you're not using it this year, it's left over, it's for next year, so you're going to subtract that 900 euros from here. Okay, subtracting that gives us 2,900. Okay, and then when you get to that, that's your final amount of the bill that you should have been paying for light, heat and fuel during this year. But we know again that we're only going to get 80% of each of these bills because we're going to allow 20% for drawings or private use, if you like. So 80% of that then is 2,320, and we'll put that figure up here, 2,320. Okay. Next one's more straightforward, machinery depreciation. So we look at what machinery we had. At the start of the year, we had 60,000 euros worth of machinery. So we'll start, I'm going to call that machinery depreciation. 60,000 you had at the start of the year. Okay, then what you should always do is check to see if, this is the lodgement section, money that you got in during the year. So you should see if you got any money in during the year from selling some of your machinery. And in this case, I don't see any. Okay, and then you should check the payment section to see if you paid any money out to buying more machinery or new machinery. And in fact, you did in this case. 6,500 you paid for new machinery during the year. 6,500. So my total amount of the cost of machinery by the end of that year is 66,500. We know down here it says depreciation is to be provided at a rate of 10% of cost. So we get 10% of that to find out what the depreciation for the year is. In that case, it's 6,650. And then, just like we did up down here, we're going to get 80% of that. And that will give us, hold on, I calculated this earlier, 5,320. 5,320. Okay. And the next one then is going to be, what do we say, repairs. Okay. And repairs should be a reasonably straightforward, probably the most straightforward calculation here. So the repairs bill we have from the question is 6,300. Okay. 6,300. There's no repairs due at either end of the year or anything else really to take into account. So it's just get a straight 80% of that. And 80% of that is 5,040. And put it in here, 5,040. Okay. And the last one then is the loan interest. Loan interest. Okay. And the loan interest, now this is a bit trickier, I suppose. If we look here at the bank loan plus 18 months interest, 16,350. Now we calculated way back here, where was it? We calculated that the interest part of that loan was the loan and interest is 1,350. Okay, so I'm going to put that 1,350 here. Now no need to go calculating it again. You calculated that at the very start when you did the statement of capital. Okay, so out of that 16,350, 1,350 was interest we already worked out. Now, the thing is that interest is for 18 months worth of interest. And you paid off that interest at the end of the 4th month of this year. So we already worked out that if you went back 18 months from the time you paid it, well, you go back 4 months and you end up at the start of the year, the 1st of January. And then you'd have to go back another 14 months to be back 18 months in total. And those 14 months were from the previous year. So an interest bill for 14 months that you owed at the start of the year and then went up from January to April, went up to 15 months, 16 months, 17 months, 18 months by the time you got to the end of April. And we already calculated our interest amount that we owed in the statement of capital as those 14 months that you owed at the start of the year. But now that we're doing the general profit and loss account for just this year, we're not interested in in including the interest that you owed for those 14 months of last year. The only thing we're interested in putting in here is the interest that you owed for the 4 months of this year. Okay, so that's our starting point. We're going to say 1,350. We're going to divide by 18. We've done this before over here, and get 1 month is 75. And this case, instead of getting 14 months, which is the figure that goes into the statement of capital, we're interested in the other 4 months, the 4 months of this year. So we're going to multiply by 4. And when we multiply that by 4, we get 300. Okay, so that's your total interest bill just for this period. But again, just like the other ones, we don't include the full amount here. We work out drawings here. We say that, look, the interest is like probably a mortgage interest or something maybe on the farmhouse, and the farmer is living in that farmhouse, so the farmer should pay some of the interest on that loan that they got to buy the farmhouse. Okay, and so we're going to get 80% of this again, and 80% of that is 240, and we're going to include the 240 here. And just while in between, I had calculated the total of these four, came to 12,920. We're subtracting the expenditure from the income and giving us this net profit figure here of 34,980. Okay.